Before 2010, if you wanted to buy a single share in India, here's what you had to do. Call your broker, wait on hold, and pray he wasn't busy. Then pay rupees 600 in commission and hope he didn't misplace your order. Investing wasn't for the common man. It was a full-time job with a VIP membership. Then two brothers from Bangalore decided to burn the whole system down. And they did it without spending a single rupee on advertising. Let me paint you a picture of what Indian stock trading looked like in 2009. You wanted to invest. Maybe you had heard about someone making money in the market. Maybe you just wanted to grow your saving beyond a fixed deposit. So you had walked into a broker office, or if you were lucky, call one on the phone. The broker would just place your order on your behalf. You had almost no visibility into what was happening. You just trusted him. And then came the bill. Full service brokers like Sheikh Khan, ICICI Direct, HDFC Securities were charging 0.3% to 0.5% per trade on both sides, buy and sell. So on rupees 1 lakh trade, you were paying rupees 600 to rupees 1000 in brokerage per round trip before you made a single rupee of profit. And that's before the hidden charges. Account maintenance fee, call and trade fees, platform fees, each one buried in a fine print document nobody read. But here's the real problem. It wasn't just expensive. It was designed to keep you dependent. The broker earned more when you traded more, not when you made more. Think about that for a second. The person advising you on your money had a direct financial incentive to make you overtrade. Every bad decision you made, that was revenue for him. The platforms didn't help either. If you ever tried to use an online trading terminal in 2008 or 2009, you know what I'm talking about. Looked like it was built by someone who had never actually traded in their life. Designed for institutional player, not for a 25-year-old in Pune trying to invest his rupees 50,000. And then there was a trust problem. India had already been burned twice. The first 1992 Harshad Mehta scam, and the second in 2001 Ketan Parekh crash. An entire generation of middle class Indian had watched the family member lose saving in the market. Investing was not just inaccessible for many people, it was genuinely scary. So that was the landscape: expensive, opaque and misaligned, and terrifying for anyone new. This is the world Nithin Kamath grew up trading in, and he hated every second of it. Now, before we get into what Zerodha built, you need to understand who Nithin Kamath actually was. Because this story only makes sense when you understand where he came from. Nithin started trading at the age of 17, not as a hobby, as a serious attempt to build wealth. He made money early, then lost it all in 2001 market crash. But here, what most people would have done at that point: quit. Nithin didn't. He rebuilt, worked at a call center at night just to fund his trading during the day. Did that for almost 3 years. Then a foreign investor saw his return and handed him 25 lakh to manage. He quit the call center, started handling more accounts, and eventually joined Reliance Money as a sub-broker in 2006, just to access a single platform where he could manage multiple accounts seamlessly. And that's where everything changed, because now he wasn't just a trader frustrated by the system, he was inside the system, and he could see exactly how the machine worked and exactly who it was working against. The gap between what brokers charge and what client actually receive, the way the entire structure was built to extract, not to serve, the reason why an entire generation of young Indian people exactly like him few years earlier. Wanted nothing to do with the stock market. He didn't see business opportunity, he saw a problem he personally hated. And in 2010, he and his brother Nikhil decided to do something about it. Now, here's the thing most people get wrong about Zerodha origin. Nithin didn't just sit down with a whiteboard, map out market opportunity, and build a company to capture it. He built the brokerage he wished had existed when he was struggling. In fact, he later admitted he didn't even think of Zerodha as a real business until around 2015. It was meant to be a small boutique firm attracting a niche bunch of active traders from online trading community. So with all that context, what exactly did Zerodha do differently? One thing, one number, rupees 20, flat, per trade regardless of the order size. That's it. That was the disruption. Where traditional brokers charge 0.3% to 0.5% on every trade, meaning a rupees 1 lakh order costs you rupees 300 to rupees 500 in brokerage per side. Zerodha said rupees 20 full stop. And on top of that, zero brokerage on equity delivery trades. If you were buying share to hold, you paid absolutely nothing. Now zoom out and think about what that actually meant. Before Zerodha, the entire Indian brokerage industry was built on a percentage model, which meant the more you traded, the more they earned. The bigger you order, the bigger they cut. Your losses were their revenue. Zerodha broke that equation completely with a flat fee. It didn't matter if you were trading for rupees 10,000 or for rupees 10 crore. The broker incentive was no longer tied to your order size. For the first time in Indian broking history, the interests of the broker and the client were actually aligned. So when you really think about it, that's not just a pricing innovation, that's trust innovation. But here, what most people miss. Zerodha didn't solve one problem. They solved three. Problem one, the knowledge gap. The market operated mostly on myth and emotion rather than knowledge and strategy. Most young people didn't invest simply because they didn't understand how to. There were no reliable free resources. The information that existed was scattered, jargon heavy, and designed to keep the retail investor dependent on advisor. So what did Zerodha do? They built Varsity, a completely free comprehensive education platform covering everything from basic investing to advanced derivative strategies. Not a marketing gimmick, not a lead generation tool dressed up as a content, genuine financial education, the kind that would help Nithin Kamath when he was 17 and figuring it all out alone. Problem 2, the cost barrier. Now you might think rupees 600 to rupees 1000 per round trip is a small number, but it is not when you are first time investor with rupees 50,000 to your name. At those fees, you needed significant capital just to overcome transaction costs before you could even start making money. The market was effectively priced out of reach for the middle class. Flat rupees 20 changed the math entirely. Suddenly, a person with rupees 10,000 could trade actively without brokerage eating their returns alive. Problem 3, the technology gap. And even if you could afford to trade, the experience was terrible. Legacy platform crashed during high volume session. Opening an account took 7 to 10 days with multiple branch visits. Mobile trading was either absent or so poorly built it was unusable. So Zerodha built Kite, a clean, fast mobile first trading platform. Built entirely in-house, designed by trader for trader, not outsourced, not assembled from third-party tools. Three problem, three answer, all pointing in the same direction. Remove the barrier, remove the cost, remove the confusion. Zero Rodha, zero obstacles. Now, at this point, you must be thinking, if the solution was so obvious, why didn't someone else do it first? Great question. Because when Zerodha launched, the industry didn't take it seriously. And honestly, on paper, they had good reason not to. First, the math looked impossible. If you charge rupees 20 flat instead of rupees 500 to rupees 1000 per trade, you needed 25 to 50 times more trades just to match the same revenue. Where would that volume come from? How would you acquire that many customers without a marketing budget? And how would you build a marketing budget without high margin? It looked like a problem. India had just come through the 2008 global financial crisis. Brokers across the country had lost money. Trading volume had fallen sharply. A model that had never been tried in India in the aftermath of global crash. With no VC money, no marketing budget, and no brand recognition, looked less like an ambition and more like a recklessness. Third, the compliance moat was real. Running a SEBI regulated brokerage is genuinely not simple. It requires substantial compliances, infrastructure, capital requirements, and ongoing regulatory engagement. Incumbents had spent decades building all of this. They believed that it was a genuine barrier to entry. In fact, zero brokerage on delivery trade was considered outright insane. Industry veterans said it simply would not work. So what did everyone miss? The incumbents were right about the difficulty. They were just wrong about what it meant. Zerodha low margin model actually forced extreme operational efficiency. Because there was no fat in the system, every single rupee had to work. That discipline, born entirely out of necessity, became a structural advantage over time. And the pricing model that looked societal. That was actually a strategy. A flat fee so obviously fair that user would explain it to their friend without being paid to. Word of mouth as an acquisition engine. Community trust as the brand. As for timing, the quiet years between 2010 and 2014 gave Zerodha exactly the time they needed to build, learn, and iterate before the massive wave of retail investor growth hit India between 2015 and 2020. They were not early, they were exactly on time. So now let's talk about what actually made Zerodha impossible to beat. Because it wasn't just the rupees 20 pricing that got copied fast. The real advantages ran much deeper. Advantage 1. Bootstrapping as a design principle. Zerodha was fully bootstrapped. No external investor, no VC round, no seed funding. The initial capital came entirely from the founders themselves. Now, most people treat bootstrapping as a limitation, something you do when no one will fund you. Nithin treated it as an architecture. Think about what it actually means to have no investor. You have no one to report to except your customers. No board asking why growth slowed last quarter. No pressure to hit a number that looks good on a fundraising deck. Every single decision gets made with one question. Is this actually good for the user? Nithin and Nikhil together retain nearly the entire company to this day because Zerodha has never raised external VC funding. Nithin has himself said that having growth capital might have allowed them to grow faster, but he acknowledges it still happened at the same pace anyway, minus the pressure of raising one round after another. They were profitable early, and instead of returning that profit to investor because they were no investor, they reinvested it into technology, compounding product quality instead of marketing spend. Advantage 2, the product ecosystem. Here's something most people don't fully appreciate about Zerodha. They didn't build one product. They built a connected ecosystem where every single piece deepened user loyalty and raised switching costs. Let me walk you through it. Kite, the flagship trading platform, built entirely in-house. Clean interface, fast execution, mobile first, designed by trader, for trader, not by an agency, not outsourced. Varsity, a free, comprehensive financial education platform, covers everything from basic investing to advanced derivatives. And here's the key insight. Users who learn through Varsity are 4 more likely to open account and stay with Zerodha. Because trust was already built before the transaction ever happened. Coin, the direct mutual fund investment with zero commission. While every other distributor was steering user towards high commission fund, Coin offered something genuinely different and user noticed. Console, portfolio analytics, P&L report, tax statement. This turned a simple transaction platform into full financial intelligence tool. Complete transparency into every rupee. Rainmatter, founded in 2014 as a fintech fund and incubator, invested in startups that extended Zerodha's own ecosystem. Notable investments include Small Keys and Sensible. Each product reinforced the other. Each one made leaving Zerodha a little harder. That's not an accident. That's a deliberate ecosystem strategy. Advantage 3, product-led growth. Now here's where it gets really interesting. Zerodha grew to become India's largest retail broker with zero paid marketing. The entire engine was a superior product, free education and word of mouth. Think about what that means in context. While Grow, Upstock and Angel One were spending aggressively on IPL sponsorship, celebrity endorsement and influencer campaign, Zerodha was building a large active user base, spending almost nothing on acquisition. The product was the ad. The user experience was the pitch deck. Advantage 4, technology as the real move. And this brings us to perhaps the most important strategic decision Zerodha made. Price parity was always going to be copied, and it was, by every major competitor within a few years. Zerodha saw this coming. So from 2015 onwards, they began building proprietary technology. Kite, Coin, Console entirely in-house, because a platform experience is far harder to replicate than a pricing model. The result, many competitors copied the Rs 20 flat fee. None have matched Zerodha platform quality, brand trust or ecosystem depth. Now let's talk about something that sounds soft but is actually the hardest thing to build in financial services. Trust. Trust is the only real product in financial services. Everything else is a feature. And Zerodha built it through 4 mechanisms, none of which involved a single marketing campaign. Trust mechanism 1, transparent pricing. Rupees 0 for equity delivery trade, Rupees 20 per order for intraday and FNO, no hidden charges, no call and trade fees, no fine print. When user didn't have to decode a fee schedule, they could trust the platform before they even opened an account. That pricing clarity did something no advertising campaign ever could. It completely removed the anxiety of being cheated. Trust mechanism 2, founder accessibility. Now this is where Nithin Kamath is genuinely unusual. He was and remains remarkably accessible online. He writes detailed blog posts about Zerodha's own financial, regulatory risk and business challenges. He answers questions on Reddit. He participates in trading community forums. In a sector where founders typically hide behind PR team and press release, That kind of directness is disarming. And when things went wrong, Zerodha response was always the same: acknowledge, explain, apologize, and fix. No corporate deflection, no spin, just ownership. That consistency under pressure was as trust building as any product feature they ever shipped. Trust mechanism 3: education before transaction. Most financial companies educate user just enough to use the product. Zerodha educated user enough to make genuinely informed decision. Even decision that might mean trading less frequently and generating less brokerage revenue for Zerodha itself. Why would they do that? Because users who feel genuinely empowered trust the platform that empowered them. They stay longer, they refer more, and they are far less likely to blame Zerodha when market move against them. Trust mechanism 4: financial strength as a signal. And finally, something that most people overlook entirely. Zerodha net worth is now nearly 40% of total customer funds it manages. Nithin Kamath has publicly stated that this makes Zerodha one of the safest brokers to trade with. In a sector where broker default and fund misappropriation have historically been real risks, that balance sheet is not a footnote. It's a selling point, and it is the kind of trust that no tagline can buy. The financial story. Let's talk numbers, because this is where the Zerodha story stop being inspiring and start being almost unbelievable. Financial year 2022, Zerodha reported a net profit of rupees 2094 crores, up 87% year on year. Operating revenue surged 82% to rupees 4,963 crores. Financial year 2023, profit after tax jumped 39% to rupees 2,907 crores. Revenue grew 38.5% to 6,875 crores. Financial year 2024, profit after tax rose to 61% to 4,700 crores. Revenue hit rupees 8,320 crores and the profit margin crossed 56%. No VC funding, no external capital, no investor to share it with. Just two brothers from Bangalore and 14 years of compounding. But here's the part that truly separates Zerodha from every other startup founder you have ever seen. When Nithin published the financial year 2024 result, he didn't celebrate, he warned. He publicly stated that Zerodha faces significant challenges ahead, from regulatory changes including possible shift in the index derivative norms, a surge in securities transaction tax, and SEBI true to label mandate. He openly anticipated a potential 30 to 50% drop in revenue. A founder warning his own user about a revenue drop before it happens in public, that is not normal. That is entire Zerodha philosophy in a single moment. So by the time Grow, Upstock and Angel One had all copied the rupees 20 flat fee, which they all eventually did, Zerodha had already moved the game somewhere else entirely. So what do we actually take away from all of this? Because this is not just a business story, it's a playbook and it applies far beyond fintech. Lesson 1. Build the thing you personally needed. Nithin Kamath didn't research the brokerage market. He bled it for a decade and then fixed it. Lesson 2. Your business model can be your marketing. Zerodha spent nothing on advertising because the pricing model was so obviously fair that users explained it to their friends unprompted. So ask yourself, if your product requires heavy marketing to convince people it's good, is the product actually good? Lesson 3. Profitability is freedom. Every VC funded competitor had to justify their growth decision to investor. Zerodha only had to justify decision to customer. That single difference compounded into 14 years of patient, high quality product building, with no shortcut. Lesson 4. Price can be copied, trust cannot. The moment Zerodha flat fee became standard across the industry, the real moat was already elsewhere. It was in Varsity, in Kite, in Rain Matter, and in 14 years of Nithin answering questions on forum instead of posing for magazine covers. Lesson 5. Transparency is a growth strategy. Every time Nithin publicly shared bad news, revenue risk, regulatory threats, platform failure, Zerodha trust with user deepened. Lesson 6. Timing is not about being first, it's about being ready. Zerodha launched in a bad market, in a bad year, with no money and no investor. But they used the quiet years to build. And when the retail investing wave finally hit India between 2015 and 20, they were the only one truly ready for it. Zerodha never had a Super Bowl movement. No IPO, no celebrity endorsement, no viral campaign. Just a flat fee, a free education platform, a fast trading app, and a founder who answered questions.